That's not good. That's not good at all.
Pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through. Thinking about all the shit that I've been through. You don't know all the shit that I've been through. All the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through. Thinking about all the shit that I've been through. Now I'm sipping on this whiskey. Got one chance and it's risky.
What's going on, ladies and gentlemen? Let me know if you can hear me, if you can see me.
Got my team behind me like a background. I don't never back down. Picking up the slack now. Now I'm focused, keep on grinding for my stacks now. I'm feeling lost in this ocean, where's a lighthouse? I keep on swinging for the fence and I ain't strike out. And yeah, that's how I'm feeling, yeah, that's how I'm feeling now. We're not here for a long time, yeah. It's 9 to 5, it's a long grind, yeah. A lot of to success, it's a long climb, yeah. Now I'm sitting here making up for time, yeah. Man,
thank you, good morning. See you guys.
I didn't know what I was.
All right, thanks for the heads up.
And this life will blindside, you better look.
Hey, Bookman, Sharon, Brian, William.
Yeah.
Cheers, my friends. Good to see you.
And this life is a race. I keep on checking my place. Now I'm riding for my team. You can tell by my plates. And this life just threw a hook. It caught me right in the face.
Hey, Andy. It's good to see you guys both. Francine. Good morning, ma'am. Welcome back. These beans. Truckers are the bloodstream of the country. Absolutely. It's the canary in the coal mine. AW. Cheers. From the deep south. Get life. Good to see you, my guy. Buenos dias, Esco. Zacatecas, Mexico in the house. Andy, I appreciate you, my friend.
Now I'm living with my choices, I just own my mistakes.
Drop some insights on GME.
How's
that for starters?
This life is the lake. Now the pressure keeps on building as I'm raising the stakes. I ain't looking for advice, now I'm looking for space. Now I'm dealing with these losses, but I know I hate the taste. Now I'm sitting back, I'm thinking as I smoke it to the face. Now it's time for these apologies, the time is too late. So bygones be bygones.
Fidelity outages through the roof.
I'ma get a hopper like Zion. Let's raise a glass, I'll toast that. Reminisce, we roast that. How I wrote them and ain't wrote back. I'm never flimsy, the goat's back. So I don't feel bad, no, not
That's
at all.
fucked up.
But a lot of years, but a lot of calls, a lot of birthdays without a call. Nigga, time for that, so fuck a fraud.
What's going on, Crack Rabbit? Michael. All right, ladies and gentlemen. Paul P. It's my guy, Paul P. You're listening to him right now. Check out Paul P. on Spotify and YouTube. The song is called Living Through.
I swear to God, this life's good. You don't know all the shit that I've been through. All the pain and the struggle.
That song hits hard.
Now I'm rolling up these papers that I smoke through. Thinking about all the shit that I've been through. You don't know all the shit that I've been through. All the pain and the struggle that I lived through. Now I'm rolling up these papers that I smoke through. Thinking about all the shit that I've been through.
What's up, ladies and gentlemen? You guys ready? We got a little bit of everything coming at you today, from charts, indicators, technical analysis, Bureau of Labor Statistics, Congressional Budgetary Office. Everything is here. All of the signs are blaring that there's a massive recession going on right now. And we're just getting started. If you really think about it, we've probably been in one since 2022, if not arguably much, much earlier. But the fact that the federal government's money printing has kept us afloat up until now. That can't continue to happen, though, because of the ridiculous amount of inflation, fears, and issues that we've seen over the last couple of years. A lot of people are currently having issues getting on Fidelity and many other brokerages. Just for references. Check this guy out right here. The company I work for, MTI, is shutting down tomorrow. This was a couple days ago. They have 480 drivers and another 150 office staff. So they're letting go of around 600 people, just shy of 600 people. And I did see the Yahoo article, and that's how I know that it's, about 600, and it's not just 480. Just, right? That's ridiculous thing to say, but almost 600 people are getting laid off from this one company in Illinois alone. I own a freight brokerage firm. We do trucking, we do distribution, logistics, and I see it just better than anybody else in the country when things start to turn down. I got it in. Opened this company basically back in 2013 in trucking, and I've seen the ups and downs every few years. 2013, 2016, 2019, 21. Everything that you guys see on your end, I usually see it coming before everybody else because the customers start to get a little quieter. The drivers, I start getting calls and emails from drivers like it's going out of style. My phone just starts blowing up with people trying to apply to work for our company. And I don't blame them because the work at their company is drying up. Or if they're contractors, they need more available work as owner-operators. Or if they're employees, they're getting laid off, unfortunately, and things like that. Big Ace says, show us the money. Matt says, have you heard of issues with selling or buying Siri options? I don't follow Siri, to be honest with you, my friend. He said, I have 50 contracts for 920 that were purchased for over 1,000. I can't do anything with them. Man, I'm really sorry, Matt. I do know that currently Fidelity is having some massive issues. I went to Down Detector just about 30 minutes ago and took this screenshot. And the average baseline is around three users that are reporting outages, but right now that number is over 1,100. Over 1,100 people are reporting issues with Fidelity at the moment. So I'm sorry if you're having issues with them or another broker, but these things happen, and that's why we're working on Lit Exchange, my friend. Tammy says, also in logistics, it hit here in 2019. It definitely hit hard in 2019. And people don't realize that there was a massive collapse in the reverse repo operations program in September of 2019 that basically was collapsing the bond market. The bond market was on fire, but 95% of people in America, and even a greater number of that around the world, have no idea that ever even happened. Still, people don't know. In New York City, it's clear as day we're in a big recession, maybe a depression. You are correct. Let's see. Matt says, I work for one of the largest drayage and warehouse providers in LA, and we have over 300 drivers, and it is eerily slow with exception to a few customers keeping us alive. They get government funding, though. That's really interesting to hear. And, I understand exactly where you're going. I wouldn't be surprised if we've done significant business with your company in the past because we've done a lot of drayage and trucking in California and specifically, Port of LA, Long Beach. So I know exactly where you're coming, man. Thankfully, we're still doing all right, but let's just put it this way. Revenues and profits are down significantly over the last, basically 12 months, even more accelerated over the last 6 months. Thankfully, we've got low overhead, but that doesn't change the fact that, numbers are down across the board for everybody. That includes my company and yours, obviously. It is so evident, guys, it's so clear that the city of Chicago is literally doing a citywide hiring freeze, effective immediately, because they have a $1 billion budget deficit in 2025 coming. $1 billion in negative cash flow for the city of Chicago. And I was born and raised in Chicago, lived there for 38 years, and I just left last August, about 12 months ago. And honestly, as much as I love it, I think it was one of the best decisions I ever made was to leave it. Miss the family, miss the friends, but slowly but surely, they seem to be trickling out of Illinois, and more and more are coming this way here, to my new home state of Texas. Ally Financial today got slammed. Their stock got crushed. This because the CEO said there are credit challenges that have intensified due to high inflation and weakening employment. Retail auto credit challenges evident in increased delinquencies and non-performing loans. And of course, what happened to that stock? What happened to that stock because they said that? Look at this. It was down 8.24% in the past week, currently sitting about $33. Matt says we have a 1.2 million square foot bonded warehouse space in LA Long Beach and another 250K in Houston. We're an asset-based company, National Road Logistics, and agent for Platinum Cargo Logistics. Cheers, my friends. Yeah, definitely familiar. Hit me up on the side if you want to collab on the business side, boss man. Sure will, Matt. Why not, my friend? Steve Brown, welcome, my guy. Matt, feel free to shoot me an email, man, over at marcel@hotshotexp.net. marcel@hotshotexp.net. Or if you don't find me there, just shoot me an email at marcelkalinovic@gmail.com. The name is phonetic. The consumer's getting rocked, guys. This is everyday people, just like you and me, and everybody else in between. This is the 99% right here. Look at this. It's rough. Let me just make this a little bit smaller so you guys can see what I'm talking about here. This is the monthly change in total consumer credit. The red line is revolving credit and the blue line is non-revolving credit. The monthly change. This isn't like the standard numbers, whether it's going up and down, but it's the change that is occurring every month. That means that the change that we're seeing right now in increasing debt for consumers is the same as it was in 2022 when we were seeing markets get absolutely crushed. And as you can see, credit debt is going up, right? And we have a couple of months where it went down. In 2020, when people got a bunch of handouts from the government, they were able to pay off their credit cards. But ever since, it still continues creeping up, higher and higher. And even though the numbers, the bars on this chart are a little bit lower in certain portions more recently than they were, the fact that the number is going to the upside is still an increase in the actual debt. A slower increase, but still an increase. And now we're at 2022 levels again. Because inflation still fucking hurts. It's cumulative. Just because inflation isn't going up as fast doesn't mean it's not going up. The price of goods, the cost of goods continues to accelerate. It's just accelerating less quickly. So all those increased costs that you're seeing in your insurance bills, homeowners and car insurances, health insurances, your grocery store bills, etc., and everything else, right, associated, has already gone up in value a significant amount, and it's going to go up even more. Just not quite as quickly as it was, and that's for now. That will accelerate even more when the Federal Reserve starts to cut rates, because that's going to be inflationary. Revolving credit monthly. At symbol 1L in Marcel at hotshotexp.net. EXP as in expediting. Hotshot expediting. So hotshotexp.net. Take a look at the revolving credit monthly change, guys. So you could see the red lines under 2020 was when people were getting money from the government. They were able to pay off some of their debt. But since then, we had 3 months of people paying off their credit cards. All that has disappeared now. The credit card debt has greatly accelerated, even skyrocketed, if you ask me. Ciao, Marcel. Thanks for doing what you're doing. It's very helpful. Ciao from Milan, Italy. Cheers, my friend. Thanks for joining us. That's why we're doing these, because this is something that's relevant all around the world. This isn't just the United States or Canada or, or Europe, but it's everywhere. Everywhere, because all of our financial systems are linked. All of them. And we all trade with each other. And what happens in the United States affects what happens overseas and vice versa. It is the butterfly effect. You guys are familiar with the butterfly effect? You guys remember that movie from back in the day? That was great. I think that was a fantastic movie. But everything has evolving consequences. And that means basically the effect is if a butterfly in China flaps its wings, the earth, the world, the wind basically is affected on the other side of the planet. Even if it's in ways that we can't correlate or understand or even physically see. Look at the non-revolving credit monthly change. We had one huge decrease in non-revolving credit monthly changes. But aside from that, it is consistent increases in credit usage around the world. JP says, I don't know about you, but I'm going to be so effing rich, my friend. And I'm sure you will. I'm not uncertain. Let's see. They're trying to break the 99%, says Eagle Eye Productions. If they can margin call the people, but there's no saving this economy. Stay hedged. Make sure you're properly hedged. So basically last month, discount retailers were lamenting the sudden collapse in our purchasing power. And we observed that the reason this unexpected hit to U.S. consumption is that the U.S. personal savings rate has collapsed. There's been a huge growth in consumer credit, even though it's slowed slightly, but it continues to grow. And credit card debt has posted its first decline since the COVID crash, but that didn't last very long. Just in time for another month of high credit card rates. Fast forward a month, and all of a sudden, July, we saw massive consumer credit growth, right? All upwards, big time. Credit taken out by Americans in July alone soared by $25 billion and is now at a high of over $5 trillion. $5 trillion in debt by Americans alone. You can see the revolving credit change here. And that's very notable because there was 2 years of gradual declines of monthly rate increases, and non-revolving credit that I just showed you guys, check this out, has surged suddenly by $15 billion in a single month. That's the biggest increase since June of 2023. And as you can see here from the chart, the second biggest since the end of 2022. Take a look at car loans, right? I just had that on the screen. Check this out. This is wild. Not in a good way either. Looks like Owen says, just checked my Fidelity account. It's back up. Very good, my friend. Happy to hear that. Zambada says, we'll see an all-time high for all indices later this year before the downfall and algorithms are running hot. And I'll touch on that at the end here. I'll touch on that here in a little while, I should say. Because for now, everything's rosy. The numbers look great. People will continue to keep risked on, basically a risk-on effect here. And everybody will pretend like everything's great and rosy simply because the stock market's trending higher. Look at auto loans. Blue student loans and red car loans, right? You can see them side by side. Car loans accelerated and rose by $8.5 billion in the second quarter of this year. The Fed's first rate cuts are going to be coming in September, right? And It's not if, but it's when. It's just a matter of time. We can see for a significant period of time, even before the Fed started cutting rates, that our economy was already doing very poorly. But because of the amount of money printing coming and spending from the government, they had no choice, because all of that is inflationary. Sending money overseas, spending money here at home on illegal immigrants coming across the border. It's estimated that the United States has spent nearly $450 billion in the last 12 months alone. That $450 billion has to come from somewhere. And the government may print it out of thin air, but you and I pay it every single day, every single time we buy anything. When you go to the grocery store, when you take care of your family, you go out for a meal, you put gas in your car, you have to, pay for your Netflix and your Spotify and your Disney subscriptions. It's all reflected in there. And so on, right? So we had these huge surges in credit card debt, student loans, car loans, non-revolving debt, mortgages, etc. And this was a surprise because according to the Federal Reserve, the average rate on interest-bearing credit cards just hit a new record high of 22.7%. 22.7%. Now that's the average. Keep in mind there's a lot of people that are getting much higher rates than that, which is a huge and vivid reminder that banks are more than happy to increase credit card rates. Do you really think that they're going to cut your credit card rates when the interest rates start coming down? Tell me, do you think that these credit cards these companies are so willing to give up profits that they're going to decrease your interest rate just because the Fed starts to cut? Absolutely not. Eagle Eye Productions says if they can margin call the people and try force retail to sell their positions to stay alive. GME says most popular stock ever. Tell all the banks that we don't need shish from you and not moving on low volume on earnings day. My ass. Zambada, you bring up a great point, man, saying that the classic stock market is the economy. Not. That's how they make retail exit their liquidity. Very, very true, my friend. Everything is fine. At least that's what you're told. Until all of a sudden, it's not. That's the way the stock markets work. Clancy says, so they're artificially pumping the markets with the plunge protection team and other methods. Yes, absolutely. The government and the central banks are forcing hedging. They're forcing a gamma ramp on the S&P 500, on the SPY, by spending taxpayer dollars that pushes the markets up ever so slightly. A lot of times what they do is they'll naked short the volatility index, the VIX. And in turn, when that happens, high frequency trading algorithms will see that and they'll have to delta hedge, because shorting of the naked shorting of the VIX means they're selling shares or options that they don't actually own. And when that occurs, again, they're using taxpayer money to do this. And I'm talking about not they. This isn't some conspiracy. This is Janet Yellen and Gary Gensler, the head and the second right-hand man of the plunge protection team. This creates high-frequency trading algorithms and quants, basically. An opportunity, no, not an opportunity, a requirement for them to delta hedge. That means that they have to hedge their positions, their short positions on the market, by going long the SPY in related ETFs and stocks. This forces the price higher, causing other high-frequency trading algorithms to pick that up, and also delta hedge in order to maintain their short positions. Here are credit card accounts' average interest rates. Ridiculously high that we're seeing right now. Consumers are absolutely strapped for cash and for equity. And it's visible in the personal savings rate. These are not conjecture and these are not conspiracies. The personal savings rate in the United States has collapsed from what was over 5% just in 2023 to the current rate of 2.9%. That's the lowest level seen since the Lehman Brothers bankruptcy in 2008. In just one single year, ladies and gentlemen, hear me clearly, in just one single year, all of the excess savings in Americans' bank accounts and brokerages from COVID are long gone. They have been spent. The credit cards were paid off, and now they're maxed out again. The bills were caught up, and now they're behind again. Homes and others were paid down, and now that's come right back. That's what all of these charts directly from the government statistics are showing you guys. You can see the personal savings rate in green. And then here you can also see the credit card debt in red. What happened during the scamdemic? The government printed money. They gave you a tiny bit, a few $100s. People saved up, and then they paid off their credit cards. And then they spent a lot of it frivolously. Not everybody, not you, but I'm just talking about people in general. Don't be upset if you did this. We got to learn from the past so that we don't repeat mistakes, right? You can see that the savings rate has hit an all-time low. It is at a record low savings rate. Let me get this out of the way a little bit so you guys can see what I'm talking about. Let me just scoot this over here instead. There we go. We're at a record low savings rate, ladies and gentlemen, and a record high credit card debt. These are not possibilities of a recession. These are sirens blaring. The loud you could possibly imagine. The Federal Reserve will cut rates this September in about 7 days. Because the economy has been screaming for them to do so. They shouldn't. When you consider the amount of people that were in bad shape, they probably shouldn't have even cut rates to begin with. But there was no choice, simply because of the ridiculous inflation. Here on this channel, we were calling for the Federal Reserve to cut rates in 2021, when Janet Yellen was warning us that inflation would become uncontrollable before the end of 2021. And here in June and July of 2020, we were begging and shouting from the rooftops for an increase of rates. I'm sorry, I said cut rates. I mean, you guys know what I meant, right? Increase rates. Excuse me. We were yelling to increase rates because inflation was about to be out of control. It was already ticking upwards on an unsustainable path because of the ridiculous amount of spending by the government. Danny says, "Hey boss, I'm living in Japan. Do you think the Japanese will not accept the dollar once it crashes?" The Japanese yen kind of hinges on the dollar in a way, and the Japanese government and institutions have trillions and trillions of dollars here invested in the United States. They need the US dollar just as much as they need the yen. So I don't think that that's going to be a huge issue. What's going to be a larger issue is the devaluation of fiat currencies around the world. The flee from fiat currencies, toilet paper, to actual real value, right? That's gold, silver, precious metals. That's real value. Look at the Discover credit card and Capital One credit card. Net charge-off ratio. Look at this, guys. Tell me that's not incredibly massive. The charge-off for Capital One net charge-off ratio has increased to highs we haven't seen in years. This goes all the way back to 2016. The Discover Financial net charge-offs are right up there with it, guys. This isn't just slowing down, this is accelerating. And as times continue to get worse, as layoffs increase, as unemployment increases, as credit card rates continue to remain elevated, as housing prices get higher and higher, the American consumer has been tapped, and we are in a recession. But look at what happens when the Japanese yen diverts from the S&P 500. Look at what happens. Every time the Japanese yen moves, the S&P follows. There's a gap and then a closing of the gap. This has trended higher for a while, for quite a while. But just like the Central Bank of the United States of America, the Federal Reserve, the Central Bank of Japan has been forced to increase interest rates. And that caused a collapse of the Japanese yen carry trade, which is still being kept up at this very moment. It hasn't been wound down. It was only ever so slightly wound down for certain positions. But there are still tens of trillions of dollars being invested in the United States with the Japanese yen. And as the Bank of Japan increases interest rates, that is going to negatively affect the arbitrage between the US dollar and the Japanese yen. The divergence here is not possible for the Japanese yen to move up to meet the S&P 500. The Japanese yen cannot move up high enough from its current levels of 144 to meet up with the SPX's all-time highs. It's impossible. The Bank of Japan is literally selling bonds at market value right now, directly to the market, just to be able to get liquidity at this very moment. The Japanese yen is not going to go back up to 160 like it once was. It's going to stay at 144 or lower. In my opinion, it's going to go lower. It will go lower. It's going to ebb and flow a little bit. Don't get me wrong. It doesn't mean straight down, just like charts. But the SPX will come down to meet with it. And what's at these levels? Right now, you guys are seeing the SPX at these ridiculously high numbers, right? 560, 550. SPY, right? The SPY is 550, 560. SPX is 5,600-ish, you know. To meet up with the Japanese yen, the SPX would have to come down to a level of around 4,800. So from the current levels of 5,500 to 4,800. That's a pretty significant drop. And that's just to meet up with the Japanese yen. If the yen doesn't fall even lower, right? It's inevitable for it to happen, though. The Japanese central bank must raise interest rates. Keep in mind, when we started to see things collapse and the Japanese stock markets went down by 13% in a single day, and ours followed, we wiped trillions of dollars off the United States stock market in the matter of 24 hours to 48 hours. The U.S. stock market's lost like 4%, 3%, 3%. Excuse me, I don't mean to overstate that. That was an increase in interest rates by the Japanese central bank of 0.15%. Not even a quarter basis point increase. Not 0.25, but a 0.15% wiped trillions of dollars off the Japanese markets and the United States markets like that. They have to keep raising, and now the Federal Reserve has to cut. Shane asks, how long is this shit going to continue? It's exhausting. Lux says, nobody's going to the gold standard. Lux, I think you misunderstood me. I never said it's going to the gold standard. I said that central banks are buying gold and silver because they know that it actually has value. Shane, to answer your question, how long is this shit going to continue? It's exhausting. My friend, this has been going on for years. Years. But we're in the end game now. This is the end game. How long it's going to take for something to break? Well, things are already breaking. But as of now, the central banks have managed to put duct tape, silly putty, yeah, sticky tack, glue, nails, and screws into the S&P to build up the Jenga tower higher and higher. Inevitably, there will be a massive correction. Inevitably. But trust me, that's not the only chart. What happens with the Federal Reserves and the SPX? Well, the SPX follows the Federal Reserve balance sheet. Look at the balance sheet, shot upwards massively in 2021 in the Federal Reserves. In the Fed Reserves, right? This is their balance sheet. And the SPX followed along, tried to close the gap. Then when they started to sell off some of the assets on their balance sheet in 2022, they did so. The SPX followed along, and the Fed decided, we're going to slow down the runoff of our balance sheet. We can't do this anymore because billionaires are getting hurt. So they stopped doing that, and they've increased now, of course, their holdings in mortgage-backed securities and many other derivatives that are extremely dangerous and toxic. Think of it like radiation. You can only withstand so much so much nuclear radiation before you succumb to your injuries. That's the Federal Reserve and the central banks right now dealing with the derivatives, the toxic derivatives currently in the system. The SPX currently is separated and created a huge gap between the Fed Reserves and the actual reserves. And the Fed is not about to buy up from, is not about to buy up another $1 trillion worth of toxic derivatives because they know they can't. If they did that, let's just say the bubble would get much, much bigger and inflation would take off and it would be completely uncontrollable at that point. So they know they can't do that. The SPX has to come down to close the gap and meet the Federal Reserves. And this has the gap. Up here, the SPX is at 5660. The Federal Reserves level, where it equates to the SPX, shows it around the 4,000 mark, 4000. Remember, the Japanese yen, to close the gap, the SPX would have to come down to 4,800, 480 on the SPY. And it would have to come down to 4,400 on the SPY to come back and close the gap with the Fed Reserves. NP says, you better get out of the city before this shit hits the fan. Well, my friend, I don't disagree with you, thankfully. I don't disagree with you at all. I think people in big cities, I'm sorry to say it if it's you, but are going to feel this in a very big way. Hey, Bigums, it's good to see you, my friend. He says, boss, look at my Twitter page quick and read the endgame posting I just posted. What the F? Yeah, sure, I'll definitely read it. Hey, everybody, give a shout out to AMC Bigums here on the channel. Thanks for joining us, my guy. Now let's pull it up. AMC Bigums. I'll switch it over to this screen right now. Let's do a stream real soon, my friend. Let's get Bigums on the channel, and we can all get together. We can get together and have a little session and really get in on Jerome Powell and Janet Yellen, Joe Biden and Kamala Harris, and really talk about the bullshit that this administration is doing. Because this Jenga tower is very, very wobbly. What? Look at this. Do you know how many times I've liked this fucking post about ordering on lit markets? This is probably like the 1,000th time I've reliked this one post, Bigums. And I'm sure everybody here knows that. Because I've retweeted this even, and it's not reposted, and it's not liked either right now. Things that make you smile. JP Morgan is down 7.11% today. Very nice. Ah, yes. I did see this. There are some I haven't seen your post yet. I'll read it in a second. But in case you guys are wondering here, AMC Bigums is posting about the Basel III endgame regulations that the Federal Reserve was implementing. They were going to increase JP Morgan Chase's initial margin, basically their margin requirements, by almost 25%. But, you know, the number one criminal, Jamie Dimon, really fought against that. And instead of raising their capital requirements by 25% to hedge against their toxic derivatives, I'm talking about $100 trillion worth of toxic derivatives. I think JP Morgan's probably got somewhere in the range of $60 trillion, $63 trillion alone in toxic derivatives notional value, and only a few trillion in assets. It ended up being an only 7% increase, 7.8% increase by the Federal Reserve for the new Basel III endgame requirements. And he goes to, Bigham's here, I should say, posted this. The changes in the endgame reproposal will cover all major areas of the rule, credit and operational and market risk. Banks with assets between 100 and 250 billion would no longer be subject to the endgame changes, other than the requirement to recognize unrealized gains and losses of their securities in regulatory capital. These changes reflect the feedback we've received from the public, improve the tiering of the proposal, and better reflect risks. And of course, instead of raising their capital requirements by 25%, they go on to say that the largest and most complex banks will be receiving an increase of only 9%. For other large banks that are not GSIBs, the re-proposal would mainly result from the inclusion of unrealized gain and losses in their securities and regulatory capital, estimated to be equivalent 3 to 4% increase in capital requirements over the long run. AMC Bingham said it would bring the reserve requirements to 19%. That's good. I'm seeing JP Morgan's reserve requirements right now, including the 7.8% increase, are only at about 12.5%. So Bighams goes on to say, so the big banks won't be affected by the endgame rule, just the smaller and medium-sized banks. Too big to fail, right, my friend? Too big to fail. So the reserve requirements are gone, he says. That's an absolute travesty. And I think it's a complete fucking joke that they would continue to say that they got their information based on feedback from the public. The public is out there shouting and screaming that these banks are committing misstep after misstep, printing money out of thin air. The majority of money that's printed comes from banks. When you go get a loan for a house or a car, they don't actually have that money. They put ones and zeros on a piece of paper and give it to you. That is the number one way that the government prints money, through banks like JP Morgan Chase. It says the DTCC is waiving margin all over again. And this time it's the end game. There's always a loophole, and the reserve requirements were the only thing that mattered. And they said we wanted to give the big banks off the hook. I have to agree with you on that, brother. They absolutely wanted to get these big banks off the hook. There's no other way for this Ponzi to continue than without letting the big banks have their way with the country. Come here, my sweet. Come here. What's up, baby? You want to say hi? Good morning.
Good morning.
Can you say good morning to everybody? Can you say good morning? No, you're going to get shy on me? Okay. If you want to go, you can go in the other room, okay? But you don't have to. This little girl, along with the rest of my family, is the reason that I like to talk about this stuff with you guys and share this information. Because in order for myself and yourself to properly position ourselves and hedge ourselves for what is currently happening to benefit our families, we have to make good decisions. And we have to make sure that we're properly hedged. Michael Jordan's ghost. Yes, my friend, you are correct on that. Hi, Britt and Tyler, and they all said good morning. Isn't that so sweet?
Mm,
You got up late today. You sleepy?
no.
No? Were you sleepy? Did you have a good night?
Yes.
That's great, baby. Mwah. Again, right, talking about gaps. Look at this massive gap here between the 2-year Treasury yield and the NASDAQ. Right? So I showed you guys gaps between the JPY, Japanese yen, and the SPX. I showed you guys gaps between the Federal Reserve balance sheet and the SPX, showing that the SPX has to come down between 4,000 and 4,800 just to be able to close that gap. Now, if we look at the NASDAQ here between the 2-year Treasury yield at currently 3.86% or so, towards the end of August, beginning of September, the NASDAQ has to recorrect downwards, right? You could say the 2-year Treasury yield is going to increase, but that's not going to fucking happen because other banks around the world are not buying our bonds. Very, very few of them are. The majority of them, some are like, Japan, for example, that needs some, but the majority of them are being purchased up. The majority of bonds and notes here in the United States are being purchased up by the federal government using the United States Treasury. Actually, when they issue them, they use money market funds, excess liquidity, seen every day in the reverse repurchase operations program, which has collapsed from 2.55 trillion at its highs of last year to only 290 billion. 2.5 trillion to 290 billion in about 12 months. That shows you just how fast the U.S. Treasury is using up all of the excess liquidity in the financial system simply to uninvert the yield curve, right? Inverted yield curve. You guys understand what that means. If you don't, it's basically the 2-year has more value than the 10-year bonds, which is ass backwards, right? If you make a 10-year investment, it should be worth more than a 2-year investment. But we had a period of around 566 days, I think if I recall that correctly, about 566 days where the yield curve was inverted. The only reason it's not inverted now is because of that 2.55 trillion that was spent by the U.S. Treasury to buy up American government bonds. There's only 290 billion left, and they have to continue to roll a lot of these bonds that are expiring. So they'll let some of them expire, but a lot of others will have to be rolled, period. Because with new bond issuances, there'll have to be new issuances. And long story short, I'm oversimplifying things here for the purposes of not boring you to death. The NASDAQ has to correct from 19,200 to about 17,500. That's a big fucking drop. That's a big fucking drop. Thank you, Raiden, Thunderbolt, Sam, Samony. Good to see all you guys. And the fact of the matter is that billionaires have been controlling and manipulating stocks and crypto for decades. Everybody from the government officials to the market makers, to the brokers, the banks, and the hedge funds. That has been the purpose of showing this to you guys. Where's that at? Here you go. I got a few of them right here. That's what I was looking for. This is what real money looks like. These are silver coins. I don't keep any gold accessible because it's got more value per ounce. But I've got a few ounces here of collectors' coins of silver that I like to use for demonstration purposes and display because I love the way they look, but they have actual value. You cannot make pharmaceuticals or solar panels or even EV batteries without this. You need this for manufacturing and many, many other goods. This is what real value is. Gold and silver. And this, fiat currencies, you could wipe your ass with it. Because this has no real value. It's a Ponzi, ladies and gentlemen. Silver and gold is one of the best hedges aside from other heavily shorted equities that run inverse to the stock market. It's great to have money in blue chips, but when blue chips collapse, which happens unexpectedly, margin calls occur. Heavily shorted equities skyrocket. Now, you guys saw with brokerages like Fidelity and others are constantly having issues. Thousands and thousands of users were reporting outages on Fidelity today. Of course, today of all days, this day of my daughter's wedding, this day of my GameStop earnings report, people were unable to buy or sell anything because they couldn't even get on to Fidelity. This is the kind of problem that a company that has $5.5 trillion in assets under management should not be having. But they do. As well as many other problems out there that we could talk about, such as payment for order flow, in which Fidelity and other brokerages like Robinhood, Webull, Schwab, etc. route your orders to wholesalers like Citadel Securities and Virtue Financial. They could then filter your order, combined with millions of others, through a dark pool, so that instead of having an actual increase in price on a stock that you bought, it makes almost no difference whatsoever. That's the purposes of dark pools. Then, hedge funds like Virtue can front run your trade, because the SEC is currently suing Virtue just for that thing right now, and they're going to court at this very moment. As a matter of fact, 2 weeks ago, a judge declined Virtue's request to dismiss the case and said that we've never seen anything like this. There is no court case like this because you allowed your fucking hedge fund to front run the orders that you bought using payment for order flow from your market maker, from these brokerages that they bought them from. Your market maker gave your order information to your hedge fund. Your hedge fund was able to front run your trades that you bought when you purchased shares of stock on Fidelity, Robinhood, Schwab, IBKR, etc., because those orders are automatically routed to the highest bidder. The highest bidder being Citadel and Virtue, because they can then make money off your fucking trade. And then they can fail to deliver when they don't have any fucking shares, guys. Again, guys, that's why we're creating a new brokerage. A stock and crypto brokerage by the name of Lit Exchange. And now you can actually own a piece of the action. You can own the company. Currently, companies like Fidelity, Schwab, and Robinhood are absolutely massive. And I'm not comparing Lit Exchange to them because this is a startup, but we have the potential to bring on an incredible number of users because retail investors are fed up. They're tired and they're sick of the fucking manipulation. The more outages, the more times that they pull the buy and sell button, the more times that they manipulate markets and reverse trades, the more people will leave. And they will look for other brokerages that actually have their best interest in mind. You can see it in the description below. Get a link to it. Our founders program is launched on a FINRA-approved funding portal called Silicon Prairie. Our filings have been submitted to the SEC Edgar website, and those are all visible here at the SEC Edgar website under our CIK number for Lit Exchange. We have filed Regulation C, Regulation D, and Regulation DA filings with the SEC for the non-exempt offering of securities. Notice of exempt offering of securities. I knew I said that wrong. I just wanted to clarify. So you can see our campaign here on the Silicon Prairie website in which you can invest in the company. So far, we have 182 founding investors who have invested $383,000 in Lit Exchange in just the last couple of weeks. And we're looking for retail investors such as yourself to own equity in the company as well as receive a plethora of other perks. Starting at $500 and going on up from there. But for as little as $500, you can own equity in the company, or get NFTs, copper coins, silver coins, gold coins, things like that, hoodies, free level 2 data subscription services for months, if not years, discounts, new investment opportunities, processes, etc., access to them, and equity share ownership percentage, in which when we IPO on the New York Stock Exchange, you would receive an equivalent number of shares based on your percentage of ownership as well. So all of this is cumulative too. So if you decide you want to invest $500 and then, say this week and then $500 next week or next month, those are cumulative. So you would then receive the $1,000 level tier of the silverback tier, in which you would get a 1 ounce silver coin, which is going to be an exclusive branded premium limited edition coin that will never be released again. 6 months alpha subscription to Lit Exchange think tanks, 12 months of free level 2 data, early access to new investment opportunities and projects, first buyer's rights of additional stock prior to our IPO on the New York Stock Exchange. And of course, that's in addition to the equity share ownership percentage that you would receive. So you'd receive the equity share ownership percentage, as well as the ability to buy additional stock before the company is going to IPO when it gets to the IPO. And if you think it's going to increase in value, you could then do that and then sell it off when it does IPO. Obviously, that's a first buyer's rights. It's not a requirement, of course. And the value just goes up from there. We're offering a significant amount of value to people as a startup because we appreciate your investments and understand that we have to deliver a very high quality of product and caliber in the actual value provided. So you're going to find some incredible opportunities here. We've got a significant number of deep fucking value investors at the $25,000 investment offering investment subscription, which I'm really pumped about. So thank you to all of you guys, all you DFV investors, but even everyone out there who is a moonwalker or a silverback at the $500 and the $1,000 investment tier. You're greatly appreciated. Your trust and support as a partner in the company is incredibly helpful, and we are eternally grateful for that, and we will make you proud as a retail investor. So I hope you guys will check that out. We just started this a couple of weeks ago, and I want you guys to go on there and see everything. You can see here, there's a link to all of the offering documents, the offering memorandum, the business plan, the pitch deck, and everything else associated there. So you guys can really get a good understanding of all the risks involved and all of the positives and the pros that are involved with it as well. Because in my opinion, there is a significantly more pros than there are cons. You can only lose up until your maximum amount invested, but you cannot lose more than that. However, the actual amounts that you could make, I can't actually speculate on, but you could speculate on that for yourself. To have the ability to get in on the ground floor of a stock and crypto broker dealer as a retail investor is practically unheard of. But again, here you can see here all of the risks are outlined here, all of the opportunities are outlined here. Business plan, the marketing plan, the executive summary, everything you can think of in this 103-page document. And in the offering website and pages itself, guys. So if you're wondering how we're going to do this, how we're going to do that, how is this going to make markets more fair and efficient? How is this going to stop manipulation? It's all there. All the information is there. You just have to look at it. I am not able to tell you everything on this presentation. For one, I'm not allowed to read it all out to you legally. And two, I can only say certain communications. And two, there is some speculative things in there that I cannot mention on a live stream. Let's check this out. Let's see. AMC Bigham says, hey, everyone, Ken wants to be too big to fail. Yes, he does. That is the prerogative. Whoops, clicked the wrong button. That is the prerogative of Ken Griffin. Keep in mind, guys, in 2008, we gave Ken Griffin billions and billions of dollars, if I recall. I don't remember how many billions. If somebody does, let me know. But the American taxpayer literally gave Ken Griffin at Citadel Securities billions of dollars in bailouts. And we all have to pay for that. You don't know you're fucking paying for it, but you are. Every single day. In the devaluation of the dollar. Think of, how much was a dollar worth in 2007? A lot fucking more than it's worth now. Keep that in mind. Back then, making You know, 80 grand a year is the equivalent to making 160 grand a year now, if not more. AMC Bigham says it was $300 million, I think. I think it's up there. It's definitely up there. I thought it was between Citadel and Virtue. Sorry, not Virtue, but between Citadel and the other market makers. I know it's in the billions. I think Citadel alone did receive several $100 million just by themselves. That's right. You are correct on that. I don't remember the exact number right now. The Federal Reserve, I intend to recommend that the board lower the proposed risk weighting for loans secured by residential real estate and loans to retail customers. The original proposal introduced more risk-sensitive approaches for residential real estate and retail exposures, but calibrated them to be higher than the Basel standards to promote domestic competitive equity. Others argued that the risk weighting would affect home affordability and home ownership opportunities and could reduce the availability and affordability of credit. Basically, what they're meaning is that if they would have implemented these capital requirements, banks would have had to keep more cash on hand and couldn't write so many risky fucking loans with ones and zeros. Thank you for sharing this. This is a little too long for me to read all on stream right now, but I'll try to summarize it on the next one. But it said basically, these reproposals of Basel III Endgame requirements bring us closer to completing the task of improving capital requirements since the global financial crisis. Guys, they've literally been kicking the fucking can since before the GFC, since before the dot-com crash. Again, be part of the retail revolution, own Lit Exchange. We want to give you the opportunity to own equity in a stock and crypto broker dealer before we IPO, something which I've never seen any other company do. Just like this fucking fat cat here on Wall Street, robbing from retail investors on Wall Street, we're not going to take it anymore. People are sick and fucking tired of this bullshit. Time for you to be Bane and put these brokers in their place. They stole from you. It's time to take back what belongs to you. Cheers, my friends. Thank you, Bighams. I appreciate you. Let's do a stream soon, my friend. We got to get on a stream together. I'm going to take a break. I'm going to be recording or going on a live stream with Zach Rector of YouTube and Twitter a little bit later in about an hour or so, guys. So I will catch you then as well. I want to say thank you to everybody here for being with us. Let me drop this link real quick here. Claunchy says, boss, you should get on Rogan's podcast. Yeah, the problem with that is I've reached out to them. And Rogan's podcast, well, it's more of a fun thing for him. He doesn't really care to talk about these kinds of issues. You know what I mean? He cares to deal with things that are more specific to things that he enjoys and things that are fun, not actually tackling real issues. I wish I could say otherwise, because I like Rogan a lot. I've been watching him for, many years now. Bigham says, what about this weekend? I think that works out, my man. Shoot me a text and let me know what time's good for you. I don't want to interfere. You got a family and a young one, a newborn. So God bless. I hope everyone's doing well and healthy, your wife and your kids. Yeah, shoot me a text, man, and let's set something up for the weekend. I'd love to do a stream or record together, whichever one works. But yeah, it's time for, this is your chance, guys. This is your chance to invest and own part of a stock and crypto broker dealer. Take a look at all the details of the campaign, because it's time. We deserve better. Yeah, hit me up on Twitter. That works well, Bighams. And if you are invested or if you're not, there's a little link at the bottom there for you guys to copy paste this to your friends. It's really, really simple. Uh-oh, my little one's crying. I'm going to have to go. But here, I'll drop this link for you one more time. There it is. Just wanted to highlight it and copy paste it for you guys, everybody. Thanks everybody for joining us. I appreciate you. Have a wonderful day. I'll see you guys in a little while. Cheers.